Let's jump right into this explainer, because today we're literally unlocking the mechanical engine of the entire financial world. I know, the bond market. It can sound a little dry, right? But stick with me here, because once you understand the simple machine running under the hood, it's absolutely going to change how you read the economy forever.
So there's this single chart out there, and it basically acts like an economic crystal ball. It's tracked by every professional trader, yet somehow it's largely ignored by beginners. But get this, it has preceded nearly every single US recession in the last 60 years. Now, to be clear, it doesn't predict the stock market directly. Instead, it predicts the very thing that drives the stock market, what the bond market actually believes is coming down the pipeline.
And you've got to understand, the bond market is this massive, sprawling financial ecosystem. It's a market far larger, and a lot of people would argue way more sophisticated than the stock market. So when we're looking at bond data, we aren't just staring at random numbers. We're reading the collective expectations of the smartest money in the world about exactly where the economy is headed. But okay, to actually read those expectations, you first have to understand the foundational law of how this market operates.
Which brings us to Section 1, the inverse seesaw.
We really need to treat the relationship between bonds and interest rates exactly like a physical machine. The absolutely crucial point here is understanding the inverse law. Basically, it's a strict mechanical relationship where interest rates and bond resale prices always, and I mean always, move in opposite directions. You know that famous yield curve that predicts those recessions we just talked about? Well, it exists entirely because bonds and interest rates move in perfect inverse proportion to one another.
Just picture a physical seesaw on a playground. It's that simple. As the interest rate's weight rises high into the air on one side, the bond price's weight is mechanically forced to fall on the other side. You literally cannot have one go up without the other going down. It is a completely locked system.
Moving on to Section 2, let's look at the step-by-step mechanism.
Let's see how this actually builds into a real transaction on the market. Say the Fed steps in and raises rates. Suddenly, newly issued bonds are going to come out with higher yields, let's say 6%. Now think about that. Suddenly, that older 5% bond you're holding, it looks a whole lot less attractive to any new buyer. I mean, why on earth would they want your 5% bond when they can just go get a 6% one brand new? Because of that reality, the resale price of your older bond simply has to fall.
Think about it like this. If you want to sell your old 5% bond on the secondhand market, you have to somehow compensate the buyer for the lower income stream they're getting locked into compared to a fresh 6% bond, right? The only way to make it a fair deal is to offer them your older bond at a discount. New bond yields go up, old bond prices go down. It really is that simple.
All right, Section 3, test your knowledge.
Let's see if we can run this engine in reverse. Imagine the Fed just cut rates by 1%. What exactly happens to the resale price of a bond that you bought last year at a higher fixed yield? Take just a second and try to picture that playground seesaw in your mind.
Okay, got it. Its price goes up. Since the Fed cut rates, all the new bonds pay less. So your existing higher-yielding bond suddenly looks incredibly attractive. Buyers are literally going to pay a premium for it to take it off your hands. This is that exact same inverse mechanism we just talked about, just running in the complete opposite direction from our rate hike example.
And that leads us nicely into Section 4, the engine of the curve. Let's bring all of this home now. Here are the golden rules you really need to lock into your memory. Interest rates and bond prices are always inverse. Always. If new yields go up, old prices go down. If new yields go down, old prices go up. Armed with this, you can now instantly predict what happens to existing bond prices the very second you hear a Fed rate decision, way before the news headlines even have a chance to explain it. You know the mechanics now.
So, we know exactly why bonds and rates move opposite each other. But I want to leave you with a bit of a provocative thought. What happens when you plot that exact relationship across time? This inverse engine actually creates 4 distinct shapes on the yield curve: normal, steep, flat, and inverted. And one of those specific shapes? It's the loudest, most accurate recession alarm bell in economic history. We're going to be diving into exactly how to read those 4 shapes in part 2 of this explainer, so you absolutely won't want to miss it. Keep learning, stay focused, and I will see you in the next one.